A very good afternoon, friends. It gives me immense pleasure to welcome you all for today's 105th webinar on takeover regulation. Thank you for all joining in our journey and encouraging and motivating us in our knowledge sharing endeavor. This is our proactive approach that SEBI has formed a committee and they want to discuss something. So in the proactive nature, we want to provide solutions to SEBI and the market feedback and the feedback of professionals. As you all know, SEBI has constituted a committee on review of takeover regulation. The terms of reference of the committee includes to advise SEBI on issue related to substantial acquisition of shares, takeover, including measures of facilitating ease of doing business. Ease of doing business is most important. And then they want to review the entire thing on the basis of past judicial pronouncement and various informal guidance issued by SEBI till date, and the advice SEBI on measure required, if any, in the legal framework for simplification, because they want to do that, how to do simplification in this, and strengthen the extent takeover regulation by adopting appropriate legal global practices in this area. So SEBI wants to understand that how they can simplify the process, strengthen the process, and when they do this, they should follow the best practices globally. And other than this, to discuss other matters, including the internal input for department pertaining to substantial acquisition, shares and takeover, because they have their own guidelines, own code of conduct, and own action. So they want to provide them, which is a part of the procedural, not the law. We are holding today's webinar is to discuss and deliberate the various issues relating to takeover regulation to facilitate ease of doing business and further strengthen the legal framework of takeover. We will forward the suggestion emerging at the webinar for consideration of the committee, because all the speakers, those who are here today, they are the expert in this area of takeover law. Day and night, they are reading, they are using, and they are implementing this law. So their input will be very useful for us, because when they use it, they realize the problems. So I have requested all the speakers that they can share their suggestions to SEBI in this program, and then we will correlate, combine every suggestion and send it to the SEBI. So we are today we are having eminent speakers for today's webinar. Mr. Arun Goenka, he is a practicing chartered accountant and is a crusader for shareholders' activism and protection. He has very rich experience of 4 decades, and he has written book on ins and outs of the SEBI takeover of board, buyback and delisting regulation. That is his book. So you can understand his depth of knowledge and inside and outside of this particular law. We welcome you, Arun Goenka ji. He is just joining. Then we have Mr. Arun Malhotra, is a founder, CapGrow Capital Advisor, LLP, and investment professional with an experience of 22 years in portfolio management, equity research, and trading. He is expert in special situation fund management also, where the takeover regulation related things are very, very important. Then we have Mr. Lalit Dua, is a promoter, director, and CEO of Rajasthan Global Securities, which is India's largest special situation company, because they also manage the same type of special situations investment. He has 25 years of experience in equity research and has been visiting guest faculty in various forums and top colleges in the UK and USA. I welcome Lalit Dwaji. Lalit is traveling abroad, and despite of this, he is participating through his either through video or through his presence. Then we have Mr. Pramod Jain, is a director plus corporate ventures and also a chairman of Plus Group, previously known as Prandhi Group. As a merchant banker, he had a unique distinction of being handled over 100 issues in a short span, having an average ticket size of more than 7.5 crore in the past. I welcome Pramod ji. Pramod ji is also in this area, and he is one of the experts in the takeover law relating to implementation and using it when the issue is takeover law is connected. I welcome Pramod ji for this program. Then we have Mr. Manoj partner in head M&A and
हाँ
transaction,
जी, क्या खबर है?
corporate advisor, uh, corporate advisor. Manoj is a partner and head M&A and transaction of corporate profession. He's a prolific speaker, and he is also in the because as a merchant banking, he is heading the takeover division, and he has in his credit more in a year more than 16 offer came, and Manoj has in and out experience of this area. I welcome Manoj for this program. We have Ravi Prakash, Associate Partner, Securities Law, Corporate Litigation, Corporate Profession, and he handles various cases relating to SEBI law, SET, and Supreme Court related to takeover. I welcome Ravi for this, and we will definitely get advantage of your input. Then we have Ms. Richika Sharma, Associate Partner, Corporate Professional. She possesses over 7-year experience specializing in transaction advisory for various deal transactions, acquisition of listed company, and she is the part of Manoj's team for takeover, and she has handled around more than 40 takeover offer till now. Friends, the structure of the webinar is that first I will do the ball rolling, and then I invite each expert to give his suggestions on this subject. And I also invite all participants to give their suggestion in chat box, and then any query, if they have, they can ask. So I will start shortly, because to give this particular law, the background should be clear to everybody. Now, one is the takeover regulation. So you have to understand the takeover regulation, why the need has come to change. So first in 1902, announcement of policy of globalization came in India. Till then, the takeover regulation was not there. 92, the SEBI came, and there are so many changes brought out in the capital market. Then in 94, on the basis of the SEBI came out the regulation first time, and then they formed a committee under the chairmanship of Justice P.N. Bhagwati, and in 97, the first time the SEBI law enacted with teeth. And after that, there are so many amendments came. Later, takeover regulation, they formed an advisory committee, TARC, and they formed under the chairmanship of late C.H. Withan. And then in 2011, SEBI notified the SAST. Till then, more than 22 amendments they have brought out in the entire period. And now there is a need after 2011. They have done so many changes, but now there is a need of overhauling of this particular law. Now, why the need of this revamping was there? Because the revamping after so many changes which has taken place, and the government is also talking about the ease of doing business, and they want to do the globalization. They want to provide the level playing field as compared to the international market and various other aspects. So on 20th November, they constituted a committee under the Justice retired S.J. Wajibdar. He was the Chief Justice of Punjab Haryana. And the SEBI has given the mandate to them that ease of doing business, and combined all the judicial pronouncements by SEBI, SET, and Supreme Court, and the various informal guidance which SEBI has given the reply to the respective companies. And then the most important thing, SEBI wants to simplify this, and they want to strengthen. So there should be a fair market. Next. Now the question is, the purpose of takeover is what? The purpose of takeover, please change the slide. The purpose of to ensure fair exit opportunity for the shareholders, to ensure fair play and exit opportunity, and to ensure fair disclosure about the change in shareholding and control in the company. Like first two is a active process, and last point is a process which is part of the first two, as well as in the dormant side also, when there is no exit opportunity you are giving, just you have to give a disclosure. Friends, if you see the current law, so the next slide, the current law is that it is, if we can divide into, there is a offer and there is a non-offer. In offer, they are saying somebody is acquiring 25% and more, and then sometime you are not acquiring 25, but you are acquiring more than 5%. That is a creeping acquisition. That is a law which is provided. And then acquiring control, where you are not taking any voting share, but you are acquiring the control of the target company. Then it is offer is trigger. And then indirect acquisition. That indirect acquisition is where share breaches limit under regulation 3 and 4 also trigger open offer. Like you are taking control of company X, which having shares in the company, listed company. And if you are taking control of this company, then automatically listed company control will come to you. So trigger will take place. So this is one part, the non-offer share, where disclosure for acquisition of 5% or more shares of the target company. If you are taking, then you have to disclose. And the disclosure of change in shareholding of 2% and more. And when already holding along with PSE more than 5% shares. And then disclosure of encumbrance, wherever you are pledging shares, you are creating any restriction. So these are the overall offer and non-offer type of things which are there where the takeover law applicable. And then they have an exemption. So exemption, they have a two category: exemption, automatic exemption under regulation 10, where interseed transfer, transmission, scheme of arrangement, buyback, insolvency, right issue, they have prescribed that if you follow this, then the exemption will automatically. But if it is not falling in this or not qualifying this, then you have to apply for exemption under regulation 11, where grant exemption for obligation to make an offer and grant exemption for strict compliance with procedural requirement of offer. So if you're not following the automatic route or some issues are there or some other issues which are there, you can apply for the exemption under regulation 11, where the exemption SEBI provides. Friends, now this is the overview I have just given you. The point is, major issue under the current law is what? And SEBI and this committee should look into. One is, there is a confusion about the control. SEBI observed in Shubham case, the right conferred upon the acquirer through the agreement amounts to control. And this matter has gone to Supreme Court, and Supreme Court matter is not clearly defined the clarity. Then Kamath Hotel, SEBI has held the existing of prospective right of safeguard once investment cannot be constituted of acquisition of control. So that is another aspect SEBI has given. Then Jet Airways, Etihad has no control over management of policy decision of Jet, as the supremacy of promoter in the board is unaffected by the transaction. So if you see this, all three cases has a different connotation, but confusing. So the most important thing which required by this committee, that they should clearly define the control. And they should define the control. Control has multiple things: joint control to single control to joint control, negative control. All these things are there where the different decisions has taken place and different points are emerging. So it is better that SEBI should come out, this committee should come out with clear-cut definition. Internationally, the control definition is very, very simple, but in India, control definition is confusing. So they have to give clarity of this. So this is one important aspect which they have to do. Second aspect, which in my opinion, what is happening in the timeline, the major issue which I am discussing with you, the timeline which they are giving, because acquisition is always between two promoters. One person is having and second is taking over. But in between, company is also there, and company has to provide various information. But these companies' informations you are not finding in time. And second is that there is because timeline is very short and you have to provide so many things in this. So this is my suggestion, that SEBI should come out that if there is because under the strict timeline, there is a possibility of you can miss out something. So the best way is SEBI should demarcate two types of things. One is anything which is connected to offer and which is a loss to the investor. If you are missing out some information, it is a violation. But if some technical issues there, And the technical issue you have missed out, which is not affecting any investor, only technical part, SEBI should give a different treatment as compared to this. So friends, other suggestions we are there, which other speaker will discuss, like definition of PSC is also required clarification. Offer timeline, the SEBI is trying to reduce to 10 days. It has some points which they have to consider. The commercial aspect, the SPA, which when you are doing, you are going through, that is allowed through the off market. In off market, you are not getting the benefit of tax. And then what suggestion can come? And there are some procedural aspects and then some legal aspects. Legal aspect is okay, but procedural aspects are also required a revamping. So what we will do, these are the things which everybody will discuss today. So they will give their point from their own angle. So I will start with, I think, Arun Goenka ji, have you joined, sir? Okay. So I will request Arun Malhotra, can you just share your point? Arun? Can you just somebody call Arun Malhotra and ask him?
Hello.
Yeah.
Yes. Am I audible?
Arun, yeah, audible, please.
Yes. Yeah. Thanks for hosting, Pawanji, and thanks to the entire team for inviting me for this panel. I think I just wanted to make a couple of points on the takeover to understand basically from the capital market perspective what takeovers are achieving. That's one part. What are the risks? And what is their objective main, and how are they being executed under the eyes of SEBI? So I'll just take 5-10 minutes. We have seen a couple of takeovers, very minimal in Indian context, but their takeover is very common in the US market. What does takeover help us achieve? It helps better allocation of resources. When two companies merge, there are synergies, both on the cost and the revenue. There's a better management discipline, which is definitely required in the Indian context. And it also leads to a better market valuation, both for the promoters as well as the minority shareholders. So one single line, what is the objective of these takeover regulations? They are designed to maximize shareholder value. And how? If the market valuation is down, by encouraging beneficial takeovers and by minimizing the risks of sometimes misbehavior by the promoters, even by the directors and the auditors and the majority shareholders. So a takeover is designed to maximize the shareholder value, to make sure that these things do not happen. As there are in every situation. A lot of times we have seen when the takeover happens, even though the objective is still to maximize the value, lot of directors, on the company board, sometimes the independent, their behave, not the behavior, but their, I would say their standing is not as it should be to benefit the minority shareholders. Maybe they are going to be, the management is going to be changed, the board is going to be changed. They have a fear of losing if the offer is successful. Then also I think we should also see the majority shareholder of the target company should not be able to sell the shares at premium, which SEBI has always addressed this issue, Hence, the price at which the majority promoter sells is same as the minority shareholders. Even in case of a delisting in SR, I think in one of the scenarios, the price, when the company was sold post the delisting, the higher price was given to the minority shareholders. And I think sometimes these acquirers, in case of takeovers, they also can, construct some coercive tender offers. Maybe a front end offer that is higher than the back end, putting pressure on the shareholders to tender. So those kind of things need to be addressed in the new draft, And lastly, what I would, in the US, I have seen a couple of examples. A lot of takeovers happen. We have not seen those kind of takeovers happening in India, primarily because the shareholder activism is not there. The institutions are passive shareholders. The retail shareholders are fragmented. And hence, lot of promoters, lot of companies are not able to find their best value. I know a lot of companies where they are trading below their cash value, which is the cash per share. And even then, there might be insignificant shareholding of institutions. But there has been no step taken by the management to maximize the shareholder value or to distribute the cash which they are holding. And it's just a passive retail and passive institution. If takeover would have been a common thing, then a lot of cases we would have seen where institutions or retail or some majority shareholder would have gone ahead and taken
Arun, your voice is not coming. Okay, I think there's some disconnection. Till the time Arun has given his 2 points. Now I will request Pramodji, if you can share your point of view on this, it will be grateful. You have to unmute yourself.
I think Arunji has joined. He was raising some point. I think he has just joined. I saw that.
No, Arun has not joined.
Okay, I just saw him joining.
I think what I'll suggest, you start.
Okay, all right. Okay.
So if Arun comes, so he has only last point, so he can tell and can move.
Yeah. Thank you, Pawanji, for inviting me. And I think this topic is very close to my heart. So it's good that I would be able to share a few of my experiences in 2 cases. One case was a proper takeover we did, hostile, and another we aborted midway. So it's although I'm not technical, I cannot say about the legal side of it, but I can just give you a commercial and a practical aspects of it. You see, the way I see that takeover code is in existence for almost about 2 decades or so. And during these years, many eras have passed, as Arun also actually pointed out, but nothing much has changed. There are many case studies where therefore, as far as takeover code is concerned, as I see, right, I mean, you need to correct me on this, the original spirit behind this code was almost similar to no confidence motion by the existing investors in new management. So provide the existing investor an exit based on a fair price as formulated by SEBI, which is fair. But is that spirit really being practiced? My answer is no. It is merely tug of war of price between as old investors becomes passive and new investors become activist, forcing all delays and litigation, etc., etc. So, I mean, saying that this is a problem I have, so I think I need to give some solution to it as well. So my solution to this problem is date of public announcement plus minus 2 days should be the cutoff date. उसके बाद जो भी फेयर प्राइस है एग्जिस्टिंग इन्वेस्टर को मिलनी चाहिए, न कि जो नए इन्वेस्टर पीएससी पब्लिक अनाउंसमेंट होने के बाद आते हैं वो उठा के आपको लिटिगेशन करते चले जाएं. तो आई ऑलवेज बिलीव that there should be a cutoff date, as you have the day I make a PA public announcement, and maybe 2 days down the line or something you can have a cutoff date, so that there is no scope for the new investor to create any kind of hurdles in clearing of the open offer. Second, underlying meaning of as per SEBI regulation is only limited to acquisition of share, which has a huge fallacy. Every acquisition is not a takeover bid. Maybe I have a 25%, but not necessarily I intend to take over. Okay, so I find the company to be very good. I may take about 27%, but does not mean that I will take over the company. Or maybe with just 5%, I would like to take over the company. I have not seen a single takeover case where the open offer has been made just to take the control of the company without an acquisition. So in my opinion, there should be a mechanism. I don't know, I'm just giving a vague this thing which you expert can designate. There should be denied voting rights. If I have got 25% and I want to opt out of the takeover code, I will put myself under denied voting rights. How it happens in legally and technical terms, you guys are the best people to do it. I'm just telling you very from a distant, this is the way I would say it. So I mean, that's one way to look at it. So you can, and that's very easy. The moment you have got on your DMAT, you can always have a flag of denied voting right. So even if I got 28% or 5% or whatever I have, I may be just an investor. I may not be an acquirer. There should be a difference between acquirer and investor. It does not mean I am a 2% means I become investor and 25% I become acquirer, or vice versa. I with 2% also I may need to acquire. So there are two aspects I have on the takeover side, which come this thing. Third, what I want, the ambit of merchant banker scope of services has to be enlarged. If a acquirer has to give an open offer, it's open and shut. Let merchant banker take up this particular activity of clearing, transparency, corporate governance, putting all the information on table. What SEBI has to do with this? You cannot deny. Suppose if I have acquired 25%, so SEBI has to clear it. In one case where I was personally involved, right, SEBI set on that takeover, then on my clearance of my offer for practically 3 years. And I have not understood the reason still, what could be the reason. So I suggest the merchant banker, should act clearing authority as far as open offer is concerned, and SEBI should not be involved. And if anything, I mean, that's what my suggestion is, that you may have to do that on that part. Hello, can you hear me? I think.
Yeah. Carry on.
Okay. So these are three aspects I have a takeover code. The number one, I said on that 25% thing and the denied voting rights of the thing. And third, I have got one more important point which may not be necessarily linked with the takeover. Selling of any shares by promoter in open market should be notified 30 days in advance. A promoter just can't come from nowhere and dump shares to the public. That's also very critical point, because I've seen the lesser known companies case. That's what's happening. A promoter can offload their holding whenever. And there's one case, I mean, there's so many cases out there which I can give, which is not appropriate to give this. Selling of more than 5% in span of 365 days by promoter must trigger an OFS. अगर आपका इन्वेस्टर का एंट्री करने के लिए आपका टेक ओवर कोड है, तो एग्जिट करने के लिए ओएफएस कोड क्यों नहीं होना चाहिए? Right, that's one thing I have. And so this is what by and large I have got these points I have, and that's all I have to hear. And one more thing, Pawanji, promoter, as I see, promoter word per se is most often most vaguely defined by SEBI, or probably is not even defined. Who is the promoter? It is not by the means or a process, but by self-proclamation. I may be holding 1% and I just tell the company I want to be designated as a promoter. So they will designate me as a promoter. So there is no process of SEBI which says you cross certain threshold and you are designated as promoter. Rather, I would go one step ahead. There should be two categories of shareholders: large shareholders and minor shareholder. In one company case, if you look at, the promoter hold 2.88%, PE fund hold 80%. PE fund have nominated their directors on the board, yet they fall part of public. How can you differentiate? How can me as a shareholder from public and them sitting on the board, they also remain public shareholder? They have got all. How can this possible? So person who's sitting at 80%, so I just go that I don't want to define as promoter. Say, company says fine, you may not be defined as promoter. I go there with 5 shares. I say I want to define as promoter. Company accepts. So the promoter as such word should be properly defined. So I think in SEBI case is not there. So there's one case I have got. And in my opinion, the promoter should be one who hold the executive designation on the board, not by way of shareholding. You see, I may have a company which is a promoter, which may be a shareholder, but I am there as a director. So who's the promoter? So the promoter is a very, very vaguely defined. So I think some promoter word also need to define. And promoter selling of promoter shares in open market, it needs to be regulated through FS mode. Any takeover by once the public announcement trigger, cutoff date is very critical to avoid any litigation and this thing. And merchant banker in question should be responsible for all transparency. That's all my submission is. Thank you.
Thank you very much. Thank you, Pramodji. I'm sharing very interesting point on the basis of your definition of promoter, because if you want to test some law, you have to test both ways, the positive side and negative side. So loosely you can say he's a promoter because on the definition. But when you are going to see that and prove that Pramod Jain is a promoter of this company, it is a very Herculean task. So tell anybody he's a promoter is very easy, but to tell that and to prove this is a promoter, it's a very tough job. You are absolutely right. The same way, like 24%, 22.99 pay, you are saying that you have to give offer for anybody who is promoter, who is holding shares, but anybody who is holding less shares, that is also issue. And definition of promoter, you rightly pointed out, is as a multiple connotation. It's a different meaning and different things. So no doubt these things require more clarification. Thank you very much. I will come back to you now, Arun Goenkaji, because I know he has to join another webinar or seminar on 5 o'clock. So Arunji, you are expert in this area. You have written books. You have as an investor, you have fought so many cases. So what is your call that what SEBI should do now, or this committee should work out the changes which will be good for this particular law and more effective and vibrant law?
Thank you, Vijay. As you rightly said, I have to take a lecture meeting in a CA Institute, and I'm present there only. Nevertheless, I feel honored that you have given me an opportunity to share my views. I will make a short submission, and two points I would like to raise. First is one of the most contentious issues for me for years together, that is payment of interest. Over here, what I find is there are 2 arms of SEBI, as we know, or rather 3 arms, but let's talk about the 2 arms. One is legislative arm and the other is executive arm. As far as the legislative arm is concerned, they are very clear that interest should be paid to all the shareholders in case of takeovers. Whereas the executive arm is still confused. There is a disconnect. See, if we go to back background of the payment of interest on open offers, the first such case which comes to my mind is Castrol India Limited. Over there, the 15% interest was paid to all the shareholders for the period of delay. Now, at that point of time, it was challenged that SEBI has no power to stipulate any penalty or in this kind of situation, and interest being kind of penalty or additional cost. SEBI, in its defense, took a position that it is not an additional cost or penalty to the in nature of penalty to the acquirer, but it is only means of compensating the shareholders who have lost the user of their money. And that is why the rate of interest came as a fixed deposit rate of interest, and subsequently it was frozen to 10%. Now, over here, what happened is, in the case of Rhodia, the acquirer took a position and presented in SAT that someone who was not a shareholder as on the trigger date, he has not lost anything. He has not lost the opportunity. So why the person who has acquired shares subsequently should be given any interest? The concept of holder in due course was missing here. We all know that any financial instrument, shares being one of them, when you make payment to a holder in due course, maybe it a hundi or shares or something, the actual payment flows down to the original person. Like if I raise a money and sign a hundi, and this hundi may be endorsed to A, B, or C, and when the payment is made to C, that doesn't mean that the payment, the benefit of the payment is not flown down to B. The same concept should be made clarified to the courts, and they would have allowed payment of interest. Nevertheless, on its legislative side, what SEBI did is, SEBI brought in subsequent changes in the 1997 regulation, and 44I was introduced, which said payment of interest to all the shareholders. Now, unfortunately, before Color Cam decision was made, this again came into for discussion in the Supreme Court, and the Supreme Court in its wisdom said all the shareholders means all the shareholders who were original shareholders. No one can say anything about this interpretation, because it is Supreme Court judgment and it is the law. Subsequently, in the 2011 regulation, SEBI thought, as we call in Hindi, interest ka tanta hi chhod dete hain. And they said interest will be calculated and paid as a part of payment price, as a part of price. So we find in regulation 8, 12 and others that interest is included, calculated, but added up into the payment price. Still, the courts or even SEBI's executive arm still refers to the Color Cam judgment and says interest is not applicable to person who is buying the shares subsequently. Somehow, I feel there has to be a more clarity on this, and SEBI should declare in its regulation that interest will have to be paid to all the shareholders who have tendered their shares. Let there be no ambiguity about it. This is one point I have to say. Another point I have is SEBI have, there are two ways of triggering an open offer. One is, as we know, when the shares are acquired for more than 25%. And the other is when the control is acquired by anyone, regardless of acquisition of shares. Like say, I've taken a printout of Regulation 4, which says, irrespective of Regulation 4 of SAST 2021, irrespective of acquisition or holding of shares or voting rights in a target company, no acquirer shall acquire, directly or indirectly, control over the target company unless the acquirer makes a public announcement of an open offer for him. Now, over here, in my memory, I've been closely following all the takeovers in the country. There has been no single case where this regulation 4 has been invoked. Companies are sold lock, stock, and barrel for thousands of crores, and no open offer is triggered. Yeah, just imagine a company with 1,000 crore turnover, 1,000 crore market cap. If 25% of it, let us say 250 crores worth of shares are acquired, then it triggers open offer. But if the 1,000 crore net worth market cap company is acquired for even 1,500 crores, no open offer is triggered. Now, what? Why? Is it not passing over the control of the target company? It looks like in the wisdom of the people executing these takeover regulation, the definition of the company is not clear. What is a company? The company is a boardroom or the statutory register where directors and all names are there. Is that a company? Or where the heart and soul of the company, where the production takes place, where the sales takes place, where the revenue is generated, is that the company? Now, in my mind, there is a full clarity that whenever an asset is sold on a slum sale basis, or the entire companies, there are so many examples I have, like in the past, there have been cases like Orchid Chemical and Abbott Laboratories and Gwalior Chemical. They were all cases where the companies were acquired for more than the market cap, yet no open offer was announced. I have some points noted down. I'd like to read it out so that I should not miss anything. Some initial such names are Orchid Chemical, with a market capitalization of approximately 1,500 crores on 15th December 2009, was taken over for 400 million, that is 1,860 crores as per the dollar value of that time. Abbott Laboratory was acquired for $3.72 billion. Gwalior Chemical in June 2009 was acquired for 82 million. Zycom in the 21st January 2013 sold its entire security system business for 224 crores to Schneider India. Orchid, a company with a market cap of 1,500 crores, was taken over at a value exceeding its entire market cap, that is at 1,860 crores. A purchase of 15% in the 1997 regulation would have triggered an open offer in case of Orchid, since it was under the 1997 regulation regime. That is, if 225 crores say Upar ka value ka shares were acquired, then it would have triggered an open offer. Over here, 1,860 crores worth of consideration was paid, but no open offer was triggered. Now, to take a holistic view, I have tried to think it over from the other side also. And to take a holistic view, I have tried to build up arguments for both the sides. Arguments in favor of not triggering an open offer in case where the promoter is ceding control to an acquirer, the promoter is exiting at a negotiated price. The regulation kicks in to protect the minority shareholders and require that if a minority shareholder is taking an exit, same opportunity should be given to the minority shareholders. Next, it is not the promoter selling his company, but it is the company selling its asset. These are the arguments which may come up that why open offer is not triggered when company is sold on asset sale basis. Now, in case of share sale by promoter, the rationale accorded to the invocation of an open offer is that the minority shareholders' consent was not taken by the promoter prior to the sale. Hence, an exit opportunity on equal term as that accorded to the promoter must be given to the minority shareholder. However, in the case of asset sale, the minority shareholders' consent was obtained through an EGM, and thus they are part of the decision-making process. Hence, open offer does not trigger. And last, the company remains listed, although liquidity may go down. But if we go to the other side of the case, why open offer should be triggered? Now, if the entire sale, like say, in case of Gwalior Chemical, I remember distinctly, it was said that entire working facilities, that is the factories, even the employees, and everything will be taken over by the incoming promoter. The company would be left with nothing, no production facility, nothing. Only the the registered office. So if that is not taking over a company, then what it is? I fail to understand. So my view is SEBI has to look into it, and SEBI has to make rules and more clear how and when the open offer will be triggered in an asset sell method. Might be they can put in a clause like say when they say 25% of the capital, if shares are transferred, it will trigger an open offer. Similarly, they can say if assets valued at more than 25% of the market cap of the company are sold, it will trigger an open offer. With that, I will close my submission. If someone wants.
Thank you, Arunji. You have rightly proved that the nitty-gritty you know, and the way you have handled these types of things. It is a no doubt the insight which you have given definitely will help the committee and SEBI to understand the problem which you have posed. Thank you very much, and I'm grateful to you despite of your other engagement. You have joined us. Thank you very much. In case you have any other point, you can pass on to us. We will compile it and send it to SEBI. Okay. Thank you.
Thank you so much. I will not be able to continue because, as you know, I have to.
Yes, I know, sir. I know. So thank you very much.
Thank you.
So Arun, you have in between we missed your voice. So you were talking about that institutional shareholder activism is not there. Institutional investors are not, they are dormant, and the retail investors are fragmented. So then we disconnected you.
Yeah. So I think the mute point which I was making to the audience is that what is the purpose of this takeover? To basically maximize the shareholder value. And a lot of places we have seen these institutional shareholders, they have become passive. So the real takeovers are not happening. You know, like in the US market where you see there will be stakeholders who will keep on enhancing their stake beyond 25% up to 40%, and then direct the promoter or the executive management to take actions which are in the benefit and interest of the shareholders. So the real objective of the takeover, which is to maximize shareholders' wealth, is not being fulfilled. So, and you know, the question arises why that kind of thing has not happened is primarily because institutions, one is they are passive. Second is beyond 5%, beyond 10%, or maybe at once they reach 25%, they have to give a mandatory, offer. Even though they are not, their intention is not to become the promoter, not to run the day-to-day affairs of the company, but they are forced to give an offer, and hence those companies, those shareholders will keep on, they will be stuck at 20 less than 25%, and the value is not derived. I see a lot of companies that are trading below their cash levels. That means the cash value per share is more than the market cap of the company. Once these takeover regulations are modified and institutional shareholders are not, I would recommend that we should seriously consider where the institutional shareholders are not considered as promoters and they are allowed to take their stake beyond 25%, as long as they do not exercise management control. So that will help create shareholder value. I think one other key aspect other than what I said was lot of responsibility lies with the board, the independent directors of the company, because they are acting in fiduciary duties, fiduciary responsibilities to act in the best interest of all shareholders. And we have already seen, SEBI has done a wonderful job in ensuring that same price is given both to the promoters and the minority shareholders, and minority shareholders are not shortchanged. But to enhance, to derive more efficiency, I think this 25% trigger by any person, any entity, once it reaches, that should be seriously considered. Second point, I think, which previous speakers are mentioned about, when the interest should, whom should get the interest. I think this was contested well in the overseas markets in US especially, and it was held that whosoever holds the instrument on the last day is eligible for all the benefits. And this we have seen in debt instruments also. So for example, if I hold a debt instrument for 11 months and I come and sell it to you, even though you were holding it for 1 month and the date of interest payment is 31st December, you will be entitled for the full 12-month interest, while the market price will take care of the interest component, and it should include, but the company will pay interest to the holder of the instrument who holds it on the last day. I think other than this, I covered majority of it, but my recommendation would be that the process should be made smooth. It will lead to better resources allocation, better discipline among the management and the promoters, and better market valuation for all the stakeholders. I think that's my submission.
Okay, Ravi, Arun, thank you very much. I just disputing on your last point. What is happening, what Pramod Jain has said, there is a merit also. What you are saying is a practice also. The point is, what is happening? I'm an investor holding shares, and suddenly the market movement is taking place. I have sold shares and you have purchased. And you are a professional investor who is litigant. So the point is, if you see all the litigation in so many companies, whether it's a Salya, whether it's a other company, the fight was with these shareholders, those who have acquired shares later on, not the shareholder, those who are holding shares. You have your own point, but when the legislator is making something, they have to be balanced. So they have to work out that what is the best way, which can reduce litigation also, which can give a simplification things also.
Yes, agreed, Pawanji, on that front.
Yeah. So now, friends, we have another speaker, Mr. Lalit Dua. He's traveling abroad, but he was kind enough to send us his video to us, and he is just now he finished this and sent it because his connection, where he's traveling, there's a problem. So now I'm request the Lalit's video, please start.
I am Lalit Dua from Rajasthan Global Securities Private Limited, and I must thank Pawan Vijayji and corporate professionals so as to give me a chance so as to speak at this honorable forum. At the outset, I would like to applaud, I would like to clap, I would like to thank, I would like to tell everybody that SEBI is amongst the most proactive of all the regulators in our country. It is also the most interactive. It has been continuously bringing out consultation papers. It has been constantly reaching to all stakeholders like industry, intermediaries, and the investors. It has been continuously seeking suggestions, inviting comments, commissioning reports, and accordingly changing and molding the rules and regulations so as to keep up with the continuously evolving capital markets landscape on a very dynamic basis. Even as we speak today, we must acknowledge once again, we must appreciate, we must applaud the regulators' wonderful, innovative, and business enabling change in the delisting regulations. What is that? It is the counter offer option, which enables an acquirer and a promoter to make a counter offer in the event the price discovered through the RBBS is not acceptable to the acquirer. Why sometimes the acquirer rejects the RBBS price? It could be very high. The acquirer may not have the finances. The acquirer believes that the discovered price isn't viable for the acquirer. It doesn't make business sense, or there could be enough multiple reasons. And in the process, both the party loses. The acquirer, which had made the initiative so as to delist the company, must have gone through lot of effort so as to delist the company and take the company private. And even the minority shareholders would have thought that they would get a fair deal, a very lucrative price as compared to the prevailing market price. But what happens is there is a deal breaker. Neither the acquirer is able to get the company delisted, neither the minority shareholders who were thinking that they will be laughing all the way to the bank by getting a lucrative price, which is at a premium to the prevailing stock market price. They don't get that price because the discovered price is too high for the acquirer, and they eventually have to forcefully reject it. Now, what has been done? Our regulators have done a wonderful initiative by bringing a counter offer option in the delisting, which in the KBC's form is called a second lifeline. Lifeline, which has been infused by a second chance by introducing this counter offer option, which is nothing else but in old age common parlance, which the elders used to say: come, sit down, talk, negotiate, and do a little bit of give, a little bit of take, based upon the principles of negotiation and mediation and arbitration. The live example that I'm referring to is the ongoing counter offer in the DFM delisting by the acquirer, whereby the discovered price was 525, but the acquirer have given an counter offer of 457 rupees. I think it is a time to think on the similar option in the takeover matters too. This is because we all know that the open offers, the takeovers, are far more frequent than the delistings. Now, why such a need? Why I want to dwell upon this fact? This is because there have been too many stalemates. There have been too many deadlocks that have been happening in the takeovers while complying with the open offer regulations. And these stalemates, these deadlocks, these disputes happen maybe because of differences over the open offer price, the trigger dates, whether an open offer has been even triggered or not, or the application of the law, or whether the interest is payable, to whom it is payable, and in the case of delay in the open offer in its quantification, what should happen. If the above stalemates remains unresolved, then it hends for an unnecessary litigation, which is often a black hole for both the parties, but particularly for the minority shareholders. Nobody wants a litigation. Everybody wants a sound sleep, particularly the acquirer. They want a more sound sleep. Instead, now, if a counter option would have been available, and if it is introduced in the SAST matters as well, as it has been very laudingly introduced in the delisting matter, where by live example we are witnessing the case of DFM Foods, inspired by the delisting model, of course with appropriate adjustments, then I am sure the open offer and the takeover disputes will almost end, and there will be lot more deals which will quickly proceed towards the resolution rather than the unnecessary litigation. As I have told you, nobody wants a litigation, neither the acquirer, neither the minority shareholders, and everybody wants a very sound sleep. Now, what happens is that these disputes or the differences, they occur either between the acquirer or the regulator, or between the acquirer and the shareholders, or sometimes between the shareholders complaining to the regulator that they have not been given a fair price by the acquirer. Through the option of a counter offer, there would be a kind of mediation, there will be a kind of arbitration, there will be a kind of negotiation which will be attempted by bringing both the opposing camps to the negotiating table, which our elders used to say, the common parlance. Okay, let us sit down, let us talk, let us resolve our differences, where both the camps reassess their demands and expectations and retune and rework them so that the deal reaches the conclusion. How and above can be done will require, of course, more brainstorming, but a few suggestions I have, which immediately at the cusp of a moment in my mind I can dwell it. In the case of an open offer price dispute, the same can be referred to a small committee comprising of a representative, each of the acquirer, the regulator, and the public shareholders of the target company, which will, then its wisdom, suggest the counter offer price. The representative of the public shareholders may preferably be selected from one amongst the top 10 shareholders while ensuring, by way of declaration, that he is not related to the acquirers or to the selling promoters in any way whatsoever. Thereafter, the counter offer price so determined by this committee should be validated by the minority public shareholders of the target company, who will also be provided with detailed rationale, explanation, computation for the aforesaid counter offer price by way of an explanatory memorandum with minimum two-thirds votes in the favor of their shareholding. The voting may also be done based upon the electronic mode on a short day, like assume 7-day notice, which is also being done in the case of the current IBC matters also. Further, in the case of dispute over the trigger dates, the different open offer prices based upon the different trigger dates can be worked out, and a midway, a median way, a mean way can be approached, thereby considering while the counter offer price could be, which will be subject to either two-thirds of the minority public shareholders voting same on a 7-day short notice as discussed above, which is also happening in the IBC cases. Other disputes also can be attempted for resolution, mediation, arbitration on the aforesaid lines, like the examination by a committee of all stakeholders as stated above and ratification by two-thirds majority of the minority public shareholder. Needless to say, the counter offer resolutions may not be allowed to be claimed as binding precedents by any of the aforesaid parties, as these are specific, case to case, negotiated, mediated resolutions. While the above approach, as I have mentioned, may not be the perfect solutions, these were the initial thoughts at the cusp of the moment in my mind, as this was given at a very short notice. But we can have more checks, we can have more balances, they can be still be very quicker and effective than the litigation route, particularly when we recollect here that many of the open offers, several open offers have gone up litigation even to the honorable Supreme Court, and some could not fetch real resolution for the minority shareholders, as by the time it reached the finality, either the acquirer had gone bankrupt or had become completely unwilling, what we saw in the case of Mark or Polo Hotels Limited, or the business had gone south and soar, what happened in the case of Snowsim Limited, or the market price had crossed the open offer price, whereby rendering the open offer infructuous at practically zero cost for the acquirers, what happened in the case of Goldstone Infratrek, now known as Electra, or Petty Laminations. Also, I have one more thought in mind, that whatever could be the counter offer price, as has been in the case of DFM Foods by the acquirer in the current delisting, an open offer could be run. And if the 50% of the shareholders, like the current open offer is for 26% of the expanded equity capital, so if 13% or more shareholders tender their shares in the open offer at the revised open offer price, which is acceptable to the acquirer, I think then the revised open offer price should be successful. This is all I wanted to say at a very short notice from Rajasthan Global Securities. That was Lalit Dua, and I would genuinely believe that it would help to the audience, and this could be incorporated in the consultation paper. But last but not the least, before ending the speech, I must applaud the regulator that they have been very dynamic by bringing such consultation papers, and this has kept our capital markets on a super dynamic mode. Thank you very much.
Thank you very much. Thank you, Lalit ji, in absence because he's traveling. But despite of this, he has made the video and sent it to us. And he was on the standby mode also in case video is not able to run, then he was there. But because of connection, he could have dropped in between. So that's why we have done. So thank you very much. His point is very practical. Now, friends, you have heard the four person who is the investor, who is the market player, who is doing work as a special situation fund, but now time to legal part, because the committee has to do the legality also. Whatever you want, it is not be everybody's need. But what is a law desire? Law should always be practical. Law should always be equal, and equity should be there. So now it's times to Manoj that he has since last 11, 12 years, he's looking after this department. He was a part of 50-60 open offer. He will tell us that what are the problem when the client is coming, he's discussing, because 50 offer you have given, but more than 50 offer you have not given because of so many reasons. Various disputes people have come to you and asked them. So Manoj, what is your point of view that in entire takeover law, what are the changes required? Changes mean some point which I have mentioned, you can explain in detail. That law should be clear, law should not be confusing. So you please tell us where are the changes SEBI or this committee should do. Over to you, Manoj.
Good afternoon, everyone. Thank you, sir, for this opportunity. I think takeover law, as we all know, is one of the most important securities law, and it is also one of the most complicated security law. SEBI has several regulations, out of which I think PIT regulation or prevention of insider trading, as well as the takeover, are two laws which are very much in use, very much applicable to most of the listed companies and investors. So it is always very dynamic, very regularly there has been changes since beginning. So we all know that the journey of takeover law started in 1994. After that, Bhagwati committee was formed to look into the requirement of modifications, amendments, or streamlining the regulations. Based on that, 1997 takeover regulation was introduced, which has various changes, various provisions which try to minimize the litigations, minimize the and provide right opportunity to investors for their exit in case there is a change in control of a listed company. So those, and there were detailed provisions with respect to disclosures wherever there is a substantial change in shareholding of the company. So those changes were there, and after that there had been several amendments over a period of 10 years. So it was thought better to have another committee to review the law. Then Achyutan committee was formed, and based on their recommendation, the present takeover law was formed. So as you have rightly said, the broader objective of this law is to provide fair play whenever there is a change in control in case of listed companies. So fair play is both sides. The exit opportunities to the public shareholders, if they don't want to continue with the new management, is one of the things. So fair pricing should be there, fair disclosure in the offer document should be there. Besides that, there should be a protection to the existing management or controlling shareholders, stakeholders. So counter offer opportunity is also there. So all those protections and provisions are already inbuilt in the law. Similarly, because listed companies shares are quoted in the market and anyone can keep acquiring shares, so different thresholds have been provided so that everybody can know who is the major shareholders or investors who has interest in this business. So the disclosure norms are also there. Even after 2011 takeover law, there has been several changes. Even due to technological change, I think SEBI has simplified many of the things. Various clarifications have also come. Still, there are a few important legal aspects of the law which is not clear, which has been tried to be made clear, but still there are a lot of confusion. One of the most contested topic is control. So Indian law gives, as Mr. Arun Goenka was talking, the takeover trigger point is, one of the trigger point is change in control, irrespective of change in shareholding. So regulation 4 is there, and it was earlier also, it was regulation 12 was there. So whenever there is change in control, irrespective of percentage of shares being acquired by any person, the acquirer of control need to give open offer. But the term control is defined very subjectively. It is not objective. It simply says, okay, three major checks and points are there. If you have right to appoint majority of directors, then you are acquiring the control. If you have right to control the management and decision making other than as a normal executive power of a director, then you are taking over the control of the company. If you have right to change the policy or right to influence the policy decision of a listed company, then you are in control. And if you are controlling, acquiring those controls, then there is a need for offer. But these are the only inclusive part, and there has been several litigation on this, whether certain kind of rights are control or not. So the matter was like one of the most leading case was Shubham Ventures case, where there were various shareholders' right given to the investor, and those rights were given to protect the interest of the minority shareholder who has invested into the company. So matter went up to the Supreme Court. SEBI thought that those restrictive rights or those veto rights were control, or maybe a negative control, and should be treated as trigger point for open offer. But the matter went to the SAT, took a reverse view, and matter went to Supreme Court. But by the time it went to Supreme Court, the investor has already exited, and hence Supreme Court left the matter in without deciding on this topic. Similar matter also, similar discussion also held in Kamath Hotels India case, where the SAT held that merely protective rights given to the investor or financial lenders cannot be considered to be a trigger for open offer, because they have just those rights which gives them protection. They are not influencing the policy decision making. They can stop some new policy or new business line or new decision of the company, but they have negative rights but not the positive right to change something. So that was not, and they had no ability to change those things. So it was held that they are not in control. SEBI has also rightly considered the matter in the Jet Airways case, where Etihad has acquired 24% shares, and they had out of 12 directors, they had right to appoint 2 directors. They have also looked into the shareholders agreement and looked into considering all the facts. They found that it is not a control. So we see that this control is a very typical thing. Whenever we consider some M&A transaction, let's say one company, listed company, and one another unlisted company is getting merged, and one group is trying to be part of the control, which is continuing to be in control, but another party's group is coming, which is not in will not participate in control, but because of their substantial shareholding, they want to have certain rights. So whether that will be a control or not, whether offer should be given or not, so those questions are there, and it is very important that this unsettled issue should be fully discussed and closed in case of this new line of amendment which is being proposed, or new regulation which is being proposed. I think SEBI was also of the view that this is a very critical aspect, and hence they have brought one discussion paper on bright line test for the control, where they have discussed all the facts and findings and legal position world over, and found that there are several countries where control is properly defined, or control is a trigger point. There are certain countries where deeming provisions are there, like 30% shares. If you are acquiring in a company, you will be deemed to be in control. So, but there are certain countries which does not trigger, which does not make acquisition of control a trigger point. They just give the thresholds of shareholding. Based on that, open offer trigger point would happen. So those those different practices are available world over, and we have to, considering the Indian scenario where promoter-driven companies are there, we have to make suitable law so that there is full clarity. Then another very important aspect, I think, in case of acquisition or takeover, the concept of person acting in concert is very important. Who should be considered to be person acting in concert is defined in the law, but the definition is also again inclusive type. Certain persons are deemed to be acting in concert with the person who is acquiring trying to acquire the listed company. So that concept comes only in case where there is a trigger, or there is a takeover open offer. So whenever there is a takeover, the concept of person acting in concert comes into picture. But we have seen in the judgment of Supreme Court in the matter of Daiichi Ranbaxy case that they have determined that even the relationship of holding and subsidiary does not make the two companies person acting in concert. So again, they are deemed to be acting in concert, and hence SEBI considered them as a person acting in concert because of the regulatory framework. But Supreme Court held that merely because of the relationship, they cannot be considered to be person acting in concert, and hence it has to be tested in each of the cases. So still there is, there are a lot of confusion in this respect to person acting concept, person acting concert concept. Specifically in case of disclosure norms, whenever thresholds are there, various thresholds, disclosure requirements are there, whether for those disclosures person acting in concert should be applied and to what extent it should be applied, that need clarity and need amendment in the law. I think these are the two major legal points besides the technical and commercial points, which I think all earlier speakers have already discussed, which need to be debated, and proper legal frameworks need to be made. One of few other important aspect, which I would like to deal with, is one that whenever there is a share purchase agreement which triggers the open offer, the buyers and sellers need to would enter into the share purchase agreement, but the actual transfer happens at a later date. And as we know that there is a special platform provided by stock exchanges for takeover shares being tendered in the offer. So for that, the transaction becomes on market transaction, and hence STT is paid, and hence it is a special tax rate of 10% for short-term, long-term, and 15% of short-term capital gain is applicable. Whereas the transaction between the buyer and seller has to be done outside this platform, because it cannot happen online on market, except where it is possible that the block deal is done. When block deal has certain threshold, the minimum value is 10 crore, and transaction has to happen at a price which is not less than or not more than 1% from the ruling market price. So if agreed price is not the same, not falling under this bracket, block deal window is not available, and the transaction need to be off market, and off market transaction is obviously costly for the sellers. So this is one of the critical aspect I have found in many of the cases where the transaction cost of the tax in the hands of the sellers was one of the restrictive reason where the transaction could not be materialized or discussion failed. So obviously everyone is getting benefit of selling in the market, so why not give this opportunity should be given, and separate window may be provided, like similar to the OTB platform by the stock exchanges. These are the three, I think, major issues. Besides that, there are several things. I believe that revision of offer price even during the offer period may be one of the concepts which can be debated. So I think these are one of the few points I have thought to discuss here. Rest, I think Ruchika would cover a few technical aspects which we feel to be discussed and settled.
Okay.
Thank you.
Thank you, Ruchika. Now you can cover the typical procedural aspect which people are facing problem.
Thank you, sir. Thank you very much. Good evening, everyone. So I'm glad that I have this opportunity to speak after a lot of learned speakers, and I have noted down all the pointers given by all of them. So I'll directly come to the technical aspects of takeover regulations, which being merchant banker, we also face. But before coming to the suggestions, I just want to add one line here from the track report of 2010, which was given by under the leadership of Achutam committee. So there was a statement which stated which said that there should be a balance between the shareholders' interest and acquirers' interest while framing this law. And on that objective, with that objective and intention, this law was framed. But while implementing the law, while working in it day in, day out, we face a lot of challenges at times from the shareholders standpoint, at times from the acquirer's viewpoint. So I'll just touch upon some of the viewpoints here. So my first suggestion is with respect to the reduction of the timeline of the entire takeover process. So presently, if all the, if there is none regulatory approval is applicable in any takeover open offer, then 62 working days is the strict timeline of takeover regulations, for which SEBI came out with a consultative paper in March 2022, stated that they want to reduce this timeline from 62 working days to 42 working days, which is a welcoming move. And I think the committee should take those, consultative paper into action and should reduce the timeline thereupon. But there was one specific timeline, or rather two specific timelines, which were not critically touched upon in the report, which I want to mention here is, first is on the reduction of the timeline for acquisition of control over a company. So you see, whenever before triggering this open offer transaction, there is a whole transaction going behind between the two parties. The two parties, agree upon some valuation, that they enter into non-binding term sheet, they then determine the valuation parameters, and then they enter into the formal share purchase agreement when you trigger the open offer. So the objective behind entering into this transaction is to do the business. The objective is to, from the acquirer's viewpoint, is to run the business in this target company. So I think presently under takeover regulations, there is a time frame of 21 working days from the date of detailed public statement. First public announcement comes, and within 5 working days of public announcement, DPS comes, and then from 21 working days from DPS, post to that only any acquirer can acquire the control over the target company and start doing business in it, appoint their board of directors, and do all the normal ordinary course of business activities. And this 21 working days time frame is because there is a time frame of competing offer period wherein SEBI believe that there can be certain other acquirer, some other acquirer who can come in this 15 working days time frame to bid for acquisition of this company at some higher price, which might be attractive to the shareholders. So SEBI wait for 15 working days for this competing offer period, and then remaining six working days for the acquisition of control by the acquirer. So I think this 15 working days time frame can also be reduced to some 10 working days time frame, so that this process of acquisition of control and starting the business by the acquirer can be further reduced. So this is one of the suggestion. Apart from it, as the other timeline suggestion is with respect to the tendering period. Presently, the under takeover regulations, the tendering period has to open for 10 working days. There is no minimum benchmark of that it has to open for at least 10 working days, or there is no upper benchmark. So it is exactly for 10 working days. And as per SEBI's consultative paper only, it was mentioned that in most of the cases, in almost, they have observed all the open offer cases, and 91.32% of the total shares tendered were in the last 5 working days. So they have proposed to reduce this 10 working days time frame to 5 working days. But I think there should be some discretionary provision as well, where the acquirers, even after completion of this 5 working days tendering period, can, let us assume they have given an open offer for 26% shares, and very less tendering has happened at some dedicated price, at a price of 100 rupees, and they believe that if they will revise the offer price to 150, then the tendering might happen to the 100% level. So they should have an option to, even after completion of the first tendering period, they should have an option to initiate a new tendering period with the upward revision or with the same price, as per their discretion. So that option should be given to acquirer. That is my second suggestion with respect to the timeline. Now coming to and also this, as Manoj sir has just pointed out before giving his closing remarks. So this upward revision should also be allowed for the entire tendering period process. Presently, under the law, the upward revision can be done only up to 1 working day prior to opening of tendering period. So that should also be allowed, considering the discretion of the acquirer, which I've just discussed. So these are the few suggestions with respect to the timelines. Apart from it, I think the major issue which industry was facing was with respect to acquisition of shares by trust in the promoter and promoter group category. So in 2016, we have seen a lot of whole time members order were passed by the members, giving exemption to the trust who were acquiring shares of the listed company, and generally those trusts were created for the benefit of the promoters itself. The beneficiaries were promoter itself, or their legal hires were the beneficiaries. So there is still a lack of clarity in some of the cases which we have seen very critically, that as per the definition of promoter or the definition of promoter group, which is defined under SEBI ICDR regulation, there is nowhere mentioning of trust is there. Like even if I am the promoter, and if I am the beneficiary of the trust, and any of my immediate relative is the trustee of that trust cannot be the member of promoter group as per the list of that definition which is provided in ICDR. So what SEBI, when SEBI received a lot of applications from industry for transferring the shares to the trust, so they came out with a circular wherein faster process for allowing these applications was introduced. But still, in some of the cases, it has been seen that generally companies introduced trust with very less shareholding, say 2%, 3% in the promoter and promoter group in their shareholding pattern. And then they continue to hold those 2 to 3% for some, say, odd 1 year, 2 year. And when they acquire additional shares, say 25%, then they go to SEBI to seek exemption. So I think this should not be there. Either the definition should be amended, or the clarity on this part should also come, that because it creates a lot of confusion in the industry that whether any company can introduce trust as promoter or not. So that is one part which shall be dealt with. Apart from it, talking about interstate transfers under regulation 10(1)(a), where interstate transfer is allowed amongst the qualifying persons, and where there is no requirement to make open offer if you are satisfying with 2 of the conditions given in that regulation. One which deals with the pricing parameters, that your price shall not be higher than 125% of the price as calculated. And the other is that the transferor and the transferee shall be in compliance with the Chapter 5 disclosure compliance. So the word mentioned is compliance. Now, there is no clarity whether any delayed compliance would also fall into that purview. So there were some cases in past, in some of the cases, the exemption was, the inter-se was allowed and exemption was granted. In some of the cases, it was denied. So that clarity is also required. As we see practically in a lot of cases, clients come out with these sort of queries. Apart from it, from merchant bankers' point of view, as we all know, the process is first you have to trigger the open offer. The public announcement comes on the same day. Then you have to make a detailed public statement within 5 working days. Then the draft letter of offer has to go to SEBI for within next 5 working days. But along with the draft letter of offer, there are a lot of annexures which goes to SEBI, which contains a lot of information of promoter, their build-up, their compliance status, the capital buildup of the company. So under the chapter of obligations of the target company, there is no obligation set on the promoters or the target company to provide those information to the merchant banker, which at times create a lack of which at times increases the time to process the cases by SEBI, because merchant bankers are with a very less information in their hand. They have to look at BSC to fetch the information, and on the basis of that they submit to SEBI, and then SEBI also face challenges while processing it. So as we have casted an obligation to provide the list of shareholders, as there is an obligation for the target company or the promoters of the target company to provide the list of shareholders as of the identified date to the acquirer and the merchant banker. Similarly, this sort of obligation can also be introduced, which will obviously help to give the right information within the time-bound manner, and will also help to SEBI to process it faster, in a faster way. Now, coming to the last part of my suggestion, which deals with almost most of the industry people, which is with respect to the disclosures part. So we have seen in last 2 to 3 years, there have been a lot of changes in chapter 5 in the disclosure norms. System-driven disclosure process has been introduced, whereby if the PAN of the promoters are linked, then the shareholding change would be depicted on the stock exchanges automatically, and you need not to file any disclosure. Only you have to file disclosure when there is a acquisition on PAC basis. But at present also there are a lot of clarity issues while filing the disclosures. As Manoj sir was mentioning, that the definition of PAC deals with the definition of PAC is very inclusive in nature, considering the first part of the definition. So at times the same family members who where some is acting as acquirer and some are not doing anything in that particular transaction, and some are acting as seller, they are slightly confused as to how to file the disclosure. So a lot of misrepresentation goes on public domain. The formats doesn't come as they should come, and so a lot of clarity is required. Though after seeing the FAQs of SEBI, I am of the opinion that they have tried to capture all and every aspects what should be there. But again, in the disclosure part, I think a thorough views from public should be taken, and then again FAQs or maybe amendments should be proposed in the law. My last point is with respect to Regulation 31(4), where a new provision was added some time ago, which states that a declaration of encumbrance shall be given by the promoter to the audit committee and to the stock exchanges, that apart from the encumbrance which have been disclosed either in the SGD mode or by giving specific disclosure under Regulation 31 during the entire financial year, there is no other encumbrance done by them. So this is a standard declaration which is which should be given by the industry people. But a lot of confusion is coming in this specific regulation, because some of the people are saying, if we have not done any encumbrance in the entire financial year, then why we should give even this declaration? So some clarity is also required on that part. So these were a few of my suggestions. Since I have the opportunity to speak after all the speakers, so I really liked some of the suggestions, considering the OFS by the promoter if they are selling more than 5%, and counter offer pricing, which was mentioned by Mr. Lalit Dua. So these are good suggestions. I think we can compile and we can accordingly submit it to SEBI to take it into consideration. So that is all from my side, sir. Thank you.
Thank you, Ruchika, because you are doing nitty-gritty of things. So you have seen. Now, come to the next, the last speaker, Ravi. Ravi, you are whatever mistakes the promoters are doing, whatever problems they are creating, you are giving solution for this. For some time, the promoters are coming and asking the interpretation of that they want to take over. Some hostile takeover people are coming. So your view that what SEBI should do in this?
Certainly, sir. Thank you so much. I express my regards for my fellow speakers, those who have spoken before me. Speaking at the last, and on the lighter side, it is not Ruchika, but I have the distinguished opportunity of speaking at the last. And speaking at the last comes with a lot of, it gives you a lot of material galaxy of thoughts to ponder on and reconfigure what you were thinking initially at the outset of the session. And certainly some very good suggestions have flown into the program so far. What my endeavor today would be to not extrapolate or not to give you any further material, but to somewhere recalibrate what has been discussed so far in the program. And I start with para number 8 of the report of Takeover Regulations Advisory Committee, dated July 19th, 2020. Now this para number 8 sums it all at one place and gives the fundamental notion on which takeover regulation should be brought about. or were brought about, at least the 2011 regulations after Justice Bhagwati's 1997 regulation. It reads that substantial acquisition of shares in or takeover of a listed company impacts a host of stakeholders, such as the acquirer, the target company, the management, and the public shareholder. It is critical that the legal framework regulating such substantial acquisition of shares and takeover is precise, unambiguous, and predictable, and balances multiple and at times conflicting interests of such stakeholders. Now, the report further goes on to say that, for instance, the public shareholder of the target company would be keen to get the highest possible price for his share, while the acquirer would want to shoulder the least possible financial and regulatory burden. The target company may wish to support, oppose, or remain neutral to a transaction, often depending on who the acquirer is. It then falls upon the regulator to balance the interests of various stakeholders and to provide a fair, equitable, and transparent regime that addresses the concerns of all stakeholders. So as you see, whichever facet of the coin I pick, I might get into the same predicament where I would be representing interest of a stakeholder, whereas the intent of takeover regulation is to harmonize and strike a balance in all those conflicting interests. But nevertheless, because I have to take a side, I have to speak on an issue, I will certainly do that. The first speaker in the program, Mr. Arun Goenka, who also joined after Mr. Malhotra, he pointed out there is one angle which disturbs the entire timeline of takeover regulations. This was also pointed out by Mr. Pramod Jain, and Mr. Lalit Dua especially emphasized on it. The aspect is of litigation. And most of the litigation in takeover situations, it occurs on the price. And of lately, the litigations have increased on the part of delay and to whom the interest for that delay should be paid. There is a decision of Honorable Supreme Court, which was rendered in under 1997 takeover regulation. And the judgment is famously called as Clariant's decision, rendered in August 2004, 18 years ago. And it still continues to be quoted and applied by many people, including the regulator itself, whereby the interest is paid only to the shareholders who were the shareholders on the original date. It by far applies in the way Mr. Pramod Jain articulated it should be applied. So in some of the cases, it is being applied in that way. Now, I do understand that what I'm going to speak is something which is not followed in practice, but it's contained in the literature of law of the same regulator, SEBI. Now, before I proceed to embark on the aspect I'm going to speak on, I must quote Justice Robert H. Jackson of United States Supreme Court, who in 1953, while deciding case of Brown versus Allen, said, speaking for the Supreme Court, he said that we are not final because we are infallible, but we are infallible only because we are final. Indianized version could be seen that the apex court is not final because it is right. It is right because it is final. Clariant and the judgment of Clariant, it proceeded on the language of 1997 law. And it rightly, under that language, it decided that the interest should be paid to only a certain class of shareholder who were classified as the shareholders who were there on the date when the offer was triggered and who continued to be a shareholder on the date when the public announcement was made. But thereafter, and we are talking about a judgment which is 18 years old, thereafter, SEBI in its legislative exercise consciously departed from that view. So much so that in one of its discussion papers of 4th Feb 2020, Feb 3rd 2020, they said that there are two approaches of paying interest to the shareholders in cases of delay. One is as per the Clarion, where only the shareholders who were the original shareholders on the date of trigger as well as the public announcement date were paid. And the second approach is the approach embedded and adopted in 2011 regulation, which was also discussed in the track committee report. And that approach was that you do not distinguish between the shareholders, whether they are original or they came later on. If they have tendered, the interest should go to them. And an example for that is Regulation 8, Sub-Regulation 12, in which if in case of indirect acquisition, your DPS is published after 5 days limit, of course, you are allowed to do it after concluding your primary transaction, but then you have to pay the interest as a part of the open offer price to all the shareholders without any distinguishment. Currently, also, there are few matters which are pending before the court. So therefore, I express my view in my personal capacity. That my views are strictly personal and they do not represent view of any other person or the firm. So this departure of SEBI in its legislative exercise, or we can say the quasi-legislative exercise, is not really reflecting into the adjudicatory side of SEBI. Why I say so is that initially the 2011 regulation, they only envisaged interest for delay as a matter of rule. The discretionary power were always with SEBI in terms of Regulation 44 in 1997 regulation and the set of regulations in 2011 regulation read with Section 11. Inherent powers were always there, but those were discretionary. As a matter of rule, in two cases, interest was required to be paid. One, if there is a delay in seeking any regulatory approval, which causes the delay in culmination of open offer. And second one was this Regulation 8, Sub-Regulation 12, when the DPS is published after the due time and you compensate all the shareholders with the interest. Now, SEBI thought it fit in 2020, just before the lockdown. They were reconsidering this matter and they came out with a discussion paper delineating all the issues which were considered by a Supreme Court in Clarion back in 2004. And they came out with a proposal, and the proposal says that considering the above, it is proposed that the revised open offer price may be calculated after addition of interest at 10%, and the revised offer price is paid to all the shareholders in line with the approach currently followed for indirect acquisition and delays on account of non-receipt of statutory approval. So they accepted this proposal and they inserted a new regulation, 1811 capital A, right after the 1811, which talks about a statutory approval, because they realized that delays in open offer, they do not only occur due to delay in completing the primary transaction, which could be for very genuine reasons, and delay in regulatory approvals, which could again be beyond control. But it could be relating to interstate disputes between the parties to the agreement, valuation disputes, investor complaints, delay in commencing the tendering process, delay in making payment by the acquirer, and so on and so forth, and various stages of litigation. So litigation as a factor has been included in the discussion paper. Therefore, they consciously chose to depart following their existing regime of 2011 regulation. So this is one part where a clarity should come, and this can, of course, it cannot end all the litigation, but this will certainly help in mitigating the litigation, because if the process is very time bound, it is shortened, but the ambiguity and the balance is not there, people will take it to the court. And in India, you have seen, and we all see, that the activism, and I would not say necessarily word litigious in pejorative tone. Litigious means the people have confidence in courts that they would take their matter to the court if they feel that some wrong has been done to them. So therefore, and it puts the entire takeover on toss because once it goes to litigation, and we have seen plethora of cases. Mr. Dua quoted number of names which had gone for toss due to litigation. So we should bring in certainty, and this interest and delay, how the delay should be computed, to whom interest should be paid, what should be the threshold of interest. All these questions are into litigation for nearly 2 decades now, and they should be brought to a rest. And of course, it would require thorough deliberation by SEBI, but this should be put to rest. Apart from it, because the takeover regulations are for investors, it is a beneficent law, as said in unison by everyone who was speaking before me. I also feel that the kind of disclosure the regulator wants from people while coming for an offer, which should be simple, clear, true, and accurate. It should also simplify the regulations, the wording of regulations, so that it is really easy for investors, the common investor, to understand their rights and to understand the law in its spirit. And certainly it will help professionals also. It will curb the ambiguity. It will bring more certainty. So the simplification of language should also be something which should be looked upon. Why I say so? Because if you read 1811 and 1811A, it could be read and played. The words can be played either way. So therefore, and that is where I feel that another round of litigations would happen on 1811, 1811A language, the language of those two particular provisions. So therefore, the simplicity of language should also be adopted. And I think SEBI is certainly a trailblazer in terms of deliberative legislative exercise. They have been following this approach since long, and they would have not big difficulty in culminating simpler languages into their regulations. Another aspect of my suggestion would be, and I draw it, as I said, you have benefit of others' thoughts. So Mr. Manoj Kumar made a very significant point, because technological developments have led to many changes in takeover law. That is right, because disclosure regime has taken a paradigm shift after technological development. You have automated disclosure. So therefore, if the objective is to ensure transparency, fairness, and true and accurate information, why to keep it on manual mode? Let's sum up all the disclosure requirements, all the requirements which requires for diligence in open offer, all the requirements that can be automatized into automatic mode, following the same processes. You have the data, you have the right kind of control, administrative control over the market data. So all that data can be pulled up from there. And instead of going for a deterrent approach that if you do not report it correctly, we are going to punish, they should remove the chance of inaccuracy or an error to the best extent from the market. That could be a wonderful approach which SEBI can take. That's all from my side, sir.
Okay, thank you, Ravi. Thank you very much. You have given the different dimension on this. Now, Pramodji, you have any other point? Manoj, Ruchika, which you think that is also covered? Pramodji, first I will take up from you. Any point which you think it should also be added in this? Manoj, Ruchika, Ravi, anybody, which we have given suggestion, other people have given suggestion, and something which you think this is also a point which can be there, because this is one forum where we are discussing and collecting all the points and will submit to SEBI. Manoj, you have any point?
I think, sir, I had discussed regarding control. So control has some other aspects which is not very much clear. One is direct control, another is indirect control. So indirect control also trigger open offer obligation, but and the law is there, but there are a lot of litigation, a lot of discussion, confusions relating to the indirect acquisition of control. So that is also a very important aspect. Then joint to single control is one aspect which is not very much clear, whether adding someone into the control is triggering the open offer. Yes, that is very much clear. But whether someone is exiting from the offer control and a person becomes the sole control of the company, so whether this is a trigger point or not, I think Pramod ji has discussed regarding the definition of promoter. So definition of promoter is there in ICDR regulation and not in this takeover regulation, because takeover regulation talks about the acquirers and acquirer and person acting in concert. So there may be a need for realignment of the concept of promoter or the controlling stakeholders or something like that. So there is no confusion in that. So these may be additional points which I would like to add.
Okay. Ruchika, you have any point? In the meantime, I have one query, Manoj, which you can give. If the transaction was only about issue of convertible warrants, public CCD, CCPS by the promoter company, now he has given name also RRPR holding of a listed entity of NDTV.
Yeah, NDTV, yeah.
A person Vishwanathan Vishwapravan Commercial Private Limited.
Right.
51% of the equity capital of the promoter company RRPR holding. Post the conversion of such security, will the public announcement requirement is triggered at the time of issue of CCD or at the time of conversion thereof? In other words, no loan transaction is involved, only pure issue of compulsory convertible security.
Sir, law, I think the law is very much clear right now. Offer triggers when the voting right comes into play. So shares carrying voting right is the trigger point, not the any other security. So as soon as the shares it is converted into equity, which is carrying voting right, or in some cases like if the preference shares are there and preference shares gets voting right due to default in payment of coupon, or maybe any other reason, if there is a voting right is arising in those shares, then it becomes a trigger point. Otherwise, it is not, because it is takeover law is with respect to the control. So control comes when the voting right comes, and when voting right comes only when it is equity or any instrument carrying voting right.
Okay. So I think we have tried to take the view, and I hope that we have covered the offer things also. We have covered the procedural aspects also. We have covered something related to exemption models. Something is missing.
I think exemption. Most of the things are there. There are circumstances where there is passive acquisition of shares. So for those, SEBI has already given clarity. Regulation has already given clarity that offer should not be triggered where there is a passive acquisition. So like in case of buyback or in case of voting preference shares acquiring voting right due to default of the company, or maybe circumstances. So all those circumstances are already there. And then specific exemptions cases are also clearly defined, like succession, transfer among the family members. All those are well defined. Ruchika has already touched upon the concept of trust, family trust, which is in vogue, and many of the group are creating family trust. So if the family trust is not there as a promoter from the beginning, then any trust being inserted into the control shareholding structure would trigger open offer, or it requires prior exemption from SEBI. And because many of the cases were coming, SEBI has already prescribed a detailed thing. The provision there is a requirement that it may be considered, SEBI may consider that the family trust would also be sometimes managed by some trustees which is not part of the family group. So that concept, a professional trustee concept may be there, because in larger family offices are generally managed by professional trustees, and that should be allowed subject to certain protections. So that concept may be discussed here.
Okay. So I think it's a time to close this session. We have 6 o'clock, and whatever best we can do, we have done it. And then, despite of our majority speakers are traveling, but they are the people from the market, and they have in and outs, and they are from the other side of the table also. So we have in the today's program, we have a merchant banker, we have a professional, we have an advocate, we have a special situation fund, those who are seeing the opportunity in takeover, so they work out. We have a people, those who are deep-rooted, a writer, author of the takeover law, and the expert in this area, which are always seeing some opportunities, some issues, and they are the acquirer. Okay, because some of them are acquirer also. Pramodji, you want to say anything? Because I'm seeing you. Okay. Anyway, so friends, this is time to close. So thank you very much all. A special thanks to Lalit Dwaji from abroad. He has participated. Mr. Arun Goenka, Mr. Arun Malhotra, and then Pramod Jainji, who has participated. Manoj, Ravi, and Ruchika, they are the internal part. So thank you very much, and I'm grateful that really the combined efforts of everybody has definitely will provide good inputs to SEBI, and the committee will look into this and they will work out. And I'm grateful to SEBI officials also, those who are here. They will note down, but we will compile it and send it to you also, these suggestions from our side. Thank you very much all. And friends, this journey of knowledge sharing will continue. And as you are aware that first Friday of every month, we are having the various inputs. So we will have the next program that we will do on 6th, but 30th, we have a separate program. We'll inform you about this program. Remaining things, we will update you. But in case you require any topic, anything, please write to us. We will do our best. Thank you very much. I think next webinar is on 30th, and that webinar is already this is on compounding, and I'll just tell you the practical aspects of adjudication, compounding, and prosecution under the Companies Act on Friday, 30th December. We are all, having this program, and the practical aspects of these things, because adjudication, compounding, prosecution under Companies Act is a very big topic and very complicated issue we will discuss. Thank you very much. Thank you.
Thank